that I was bullish on gold this year because I thought we were going to see, recession, which is usually good for gold, and more rate cuts, which is usually good for gold, and high inflation, which should be good for gold. All these factors were good for gold, and all those factors are just now starting to come into play. Really, since last July, August, when the labor market's starting to crack, that's when my thesis for this year started to play. But at that point, we're already at 2,500. And now that we're seeing them, I think, pick up speed. I think my outlook is actually more supported by the evidence now than it was last summer. But we're going into that, at 2,700. So we're looking at a bullish setup for gold and silver from much higher prices.
The gold market began the week under pressure as investors grappled with uncertainties surrounding interest rates, geopolitical tensions, and robust central bank demand for gold. Early on Monday, gold prices dipped sharply, testing the 50-day exponential moving average and signaling a possible shift in sentiment. Although this pullback indicates some negativity, the overall market trend remains positive, with many analysts hesitant to short gold given the current environment. Lobo Tiggre, founder and editor of Independent Speculator, addresses the volatility gold investors often face and suggests that even a drop to $2,500 per ounce from recent highs would likely represent a healthy correction and a prime buying opportunity. Tiggre argues that, instead of fearing such a pullback, investors could see it as a chance to buy at more attractive prices. Despite the recent trend of buying the dip, possibly losing momentum, gold could regain its bullish footing if it clears minor resistance levels at $2,668.52, $2,697.28, and $2,716.76. Tiggre notes that central banks are still crucial market players. While non-G7 central banks have reduced their buying due to high prices, they remain net purchasers. Western investors are increasing their interest, as shown by recent gold ETF inflows and data from the World Gold Council highlighting greater participation from high-net-worth individuals and institutions. China has recently slowed its gold purchases, with the People's Bank of China not increasing its reserves for the sixth month in October. Nonetheless, its holdings grew from $191.47 billion to $199.06 billion, driven by higher gold prices. Gold prices have surged about 33% this year, aiming for the most significant annual gain since 1979. This rally is supported by the U.S. Federal Reserve's interest rate cuts, geopolitical risks, uncertainty ahead of the U.S. presidential election, and strong global central bank demand. The gold market outlook remains positive, with corrections seen as opportunities for long-term investors amid ongoing inflation and economic instability. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
One pro-Trump thing I can say is that talking to people on the ground, geologists working with, BLM people and even Forestry Service people and so on, the last Trump administration did make a difference on the ground. I mean, the word came down from the top, from Washington, and the bureaucrats, even people who'd been there for a long time who are obstructive, that they still have to obey what their bosses tell them to do. And even despite things like that huge pebble mine in Alaska not going forward under the last Trump administration. So I'm not saying that Trump is perfect and everything's going to be great, but this drill baby drill idea of his is consistent with how Trump 1.0, as people like to say, impacted the resource sector in the United States. So they're actually, from the mining perspective, whatever the fiscal case may be, from the regulatory perspective for mining, this could be a very good thing for investors to keep in mind. So just to put that out there, as far as gold and gold rolling over, and it's so funny and human and typical that gold bugs, they're only happy if gold's going up.
Of course.
Next all-time high, even if it's just a nominal one, oh yeah, everything's great. Oh, gold is corrected to 2,700. Whatever shall we do? Think about it. If gold cratered right from 2,800 to $300 down to say 2,500, if gold retreated $300, that would be huge. That would whack the gold stocks in a big way. It would change people's decision making in a way that what we've seen so far and the fluctuations so far haven't really done. But 2,500 would be a fantastic gold price for all but the most incompetent gold miner. So, the scenario, the setup here is one where you could see a perfectly healthy bull market have a perfectly normal and even healthy correction that doesn't change the overall story or trajectory at all, but creates a spectacular buying opportunity. This is not a prediction. I'm not saying that this is what's going to happen. Gold tends to lead inflation. And as we've just been discussing, the Trump agenda is highly inflationary. So, I'm not surprised actually that we've had some correction and we're holding around 2,700. I'm not saying it can't go lower. I'm saying if it does, I would absolutely see that as a buying opportunity. I would not subscribe to the notion that 2,800 was a peak and the next 5 years are going to be down. I do not think that this year, famous last words, but I do not think that this year is going to be like 2011 all over again. If I did think that, I would have a very different thing to say to you, but I do not. I think if we get a big correction, I would absolutely, I would be as close to going all in as I ever get. I would seize that opportunity with both hands, or all four paws, as the case may be for a Lobo. As for why and what's going on and who and what, the central banks have pulled back. The BRICS or the non-G7 central banks that have been doing the buying, they have cooled off a bit. I think that's a rational response to higher prices, but they haven't stopped. Right? There's still, the net buying continues. So it's not true that central banks have stopped buying. At the same time, it is also true that Western investors are finally joining the parties. And we're seeing that in net inflows to the ETFs. The World Gold Council has reported more institutions and high net worth individuals in the West buying. I don't know where they get that data from, but for what it's worth, they're reporting that that's finally happening. And, that's very bullish.
Following Donald Trump's decisive victory in the U.S. presidential election and a recent Federal Reserve interest rate decision, investors are now eagerly awaiting Wednesday's inflation data for further insight into the future path of monetary policy. Economists surveyed by Reuters expect October's consumer price index to show a 2.6% increase year over year, slightly from the 2.4% recorded in September. Although September's CPI reading suggested a slight cooling in inflation, it still exceeded consensus forecasts, indicating persistent inflationary pressure. Core inflation, which excludes volatile food and energy prices, is projected to hold steady at 3.3% for October. This metric remains crucial to the Fed's decisions, reflecting underlying inflation trends. The Fed recently implemented a 0.25 percentage point rate cut, bringing the target range down to 4.5 to 4.75%, following a larger 0.5 percentage point cut in September amid a series of strong economic data releases. Markets are adjusting to Trump's anticipated policy moves, like trade tariffs and tax cuts, which investors expect will increase inflation. As a result, traders foresee less than a full percentage point in additional interest rate cuts by the end of next year. Analyst Lobo Tiggre notes that the Federal Reserve is cautious about declaring victory over inflation despite a strong economy, as core inflation remains high and economic risks persist. This suggests that the Fed is not fully convinced that inflationary pressures are under control and continues to focus on its monetary policy as new data emerges. Let's get back to the interview.
I think that they're well aware of the cracks in that one pillar of American exceptionalism, that labor or consumer. And so I think that while the overall narrative of continuing to cut, while it looks like we're almost there at the goal and everybody keeps talking about how wonderful the economy is, so why are we doing this? Well, I think that they realize that there's more risk there. And so I think they're addressing that. If they really thought inflation was licked, and if anything, everything was fine, there's no need to change, then, maybe they wouldn't have. But I do think there's concern there. And that's part of what the policy is responding to. It's not what they say, it's what they do. And what they did says, inflation is not licked. But it wasn't a jumbo or anything like that. So they're still concerned. I see this balance there. And sorry, one more thing. You said it's almost at 2, it's 2.1 or whatever. But remember, Powell has long insisted that the PCE, not the CPI, is the main number they look at, and the so-called core PCE is what they're really targeting. And I'm not sure what the official mandate may be. I mean, it's not actually written in the law what their target metric should be. I mean, the law doesn't say the Fed shall meet X percent of CPI, X to be defined by Congress or something like that. That's not what it says. They have this dual mandate, full employment and stable prices. It doesn't say CPI, PCE, or whatever number you want to invent in there. So it's up to them to decide what their goalpost is. And the goalpost they've made the most noise about is core PCE, which is not coming down. It's stuck just under 3%. It's gone flat for the last three prints, 2.7. Okay, it was 2.65, whatever this time. But basically, it's going sideways for a month after month. So if I'm the Fed and I'm looking at the number that I've said is the most important, and it's sticky, then no, I can't say, oh, job done. Let's stop cutting. We're at the, what do they call it? R star. We're right now. We're sufficiently. It's Goldilocks. It's not too hot, not too cold. It's just right. Well, it's interesting because I'm not a believer in the dreaded wage price spiral. I mean, yes, you see that dynamic, but that's not the root cause. To give credit where due, Peter Schiff does a great job of explaining this. And he says that properly understood, the wage price spiral is the price spiral. Like wages are just a price, a price of labor in the market. And the real root cause is, of course, real inflation, i.e. monetary inflation. And an aspect of this is, consumer prices go up, consumers demand higher wages, right? And then the employers have to raise their prices. And so, yes, there is this kind of cyclical spiral activity, but it doesn't self-cause itself. And it's not confidence that makes it go up. It's monetary inflation. That he really almost as vehemently as he said no, he wouldn't quit if Trump asked him to step down, he just as vehemently said no, we can't declare victory on inflation yet. So I think this fits with everything we're talking about. The ball he has his eye on, at least according to what he said, is core PCE. It's not there yet. It's sticky, and there's signs of trouble in the economy. So he's trying to balance not having beaten inflation yet, but being aware all is not as well in Mudville as everybody would like to proclaim.
Gold's market resilience in the face of current economic and geopolitical pressures suggests that any short-term pullbacks may offer valuable entry points for long-term investors. The sustained demand from central banks and increased investor interest indicate solid fundamentals supporting gold's outlook, even as inflation and interest rates shape the near-term landscape. With ongoing uncertainties, gold continues to attract attention as a potential haven. How might anticipated policy shifts and continued inflation impact gold's appeal as a safe haven investment for global and individual investors? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.